Welcome to this channel Business Charts. This is a fundamental analysis series and this episode is all about Polycab. This is a quantitative side of analysis. We will look into past 9 years of financials, important ratios, analyst forecast, valuation of the company and shareholding trend. Sharia complaint statement of the company is passed in all applicable sections. Let's start the financials from income statement. In the last 9 years, sales year-on-year growth increased at double digit in most of the years, and only one time sales declined by just 0.4% in 2021. Sales numbers are almost consistently increased till now, and CAGR is 15.5% in the past 9 years. So company performed very well in terms of sales. The net profit year-on-year growth numbers are also almost increased at double digit. In few years, year-on-year growth is even higher. It is around 40 to 50% and consistently increased throughout the years. CAGR is 32.9%, so company performed very well in terms of net profit as well. Expenses side, raw material cost consumes most. In every year, it is around 70 to 80% of the sales. Employee cost is just 3 to 4% of the sales. Other operating expenses like power and fuel, advertisement, admin and distribution expenses. So altogether it is around 10 to 14% only. So raw material cost is huge portion in the expenses. Operating expenses with the other income, here the other income contributing less than 10% of operating profit. So core operation is generating more money for this company, because consistent higher other income is not good for any business. In the balance sheet, liability side there is no considerable debt, it is around 1% only. But account payable is around 16%, which is outstanding amount to pay to vendors or the material suppliers. Asset side, they have 30% inventory. Over the last 9 years, business holds around 30 to 35% inventory as raw materials, as well as the final products. So inventory management is good. And a cash and short-term investment which is around 16%, so they have enough liquid assets. Fixed assets maintaining at around 30% level, so overall very healthy balance sheet. In the cash flow statement, operating cash flow is not consistent. Last 4-5 years there is a huge up and downs, so no steady operating cash flow. Comparing to the net profit, we can understand the up and downs. So except last year, the capital expenditure is around 200 to 300 crore for every year. Last year it was double than the previous spending. In few years, Capex is even higher than operating cash flow. So the free cash flow is negative in 4 years out of 9 years. It looks there is no proper trend and free cash flow is not easily predictable. It may affect the dividend payouts in future. So overall from the financial sections we can understand sales and net profit growth is good, and major expenses are raw materials, and balance sheet is healthy but cash flow is not predictable. The profitability of the company is an important thing for every shareholders. If we look into the operating profit margin, it was just 8.3% in 2014, but then it is gradually increased to 13% in 2020, which is good trend. But last year it was declined to 10.2% from 12.6% because of higher raw material price. The net profit margin is increased from just 2.4% in 2014 to 10% in 2021. Which is super improvement. But last year it was declined to 7.4%. From these two margins, I can easily see it is operating in somewhat competitive industry. Return on equity is 16% in last year, and last 5-year average will be around 17 to 18%, which is also good return. Return on capital employed is 22% in last year, and last 5-year average will be around 25%, which is also good. So overall profit margin is not good for investors who prefer moat investing style, as the company is operating in a competitive industry, but generate a decent return. Here interest coverage ratio is an important one. This company earned more than 20 to 30 times to pay the interest expenses, so very healthy position. In any bad economic situation, company can easily pay their interest expenses. Debt to equity is 0.01 times. There is a very low debt. Here current ratio is 3 times in the last year, and trend is improved from 1.5 times to 3 times over 5 years. So more than 1 time is very good. And quick ratio is 1.4 times, so they can easily close their short-term liabilities by cash and cash equivalents itself. No need to sell any short-term assets to pay off the current liabilities. So short-term and long-term sustainability ratios are good. The asset turnover ratio is more than 1.2 times in every year, so company efficiently using their assets. Inventory turnover is almost flat at 3.3 times and it was improved to 4.6 times in last year. The cash conversion cycle is almost flat around 80 to 90 days and it was improved to 72 days in the last year. So company takes around 3 months for converting its investment into cash flows. So all efficiency ratios looks good. Other key ratios, company increased their book value steadily at double-digit rate for every year. Yes, it is a good thing. And earnings per share also growing at almost double-digit for every year. In the last 9 years, the earnings per share value is almost increased to 10 times. From 6.2 in 2014 to 60.8 in 2022. Really good growth. Number of shares is a general check at the dilution point of view. The adjusted number of shares increased in 2014, so the corporate action is they have issued 1:1 bonus. And 2019, the company issued fresh shares towards IPO. So only one time in the last 9 years, company raised funds through share issues, but they don't have any buyback history. Working capital amount is all positive, so company can easily fund to its operation without raising debt or without diluting shares. So short-term financial health is very good. On the net profit, they have retained more money for expansion and future growth. Dividend payout is not consistent. A few years company not given any dividend. Payout score is a combined score. It is used to understand the strength of financial positions. 9 is the best one and maximum score. 0 is the worst and lowest score. Out of 9, the company's score is 6 in 2022. The trend in last 5 years is not in good. Alsman Z-score is used to check the credit risk of the company. It is also the combined score. This indicates whether the company is headed for bankruptcy or not. More than 3 is considered good. Less than 3 is likely headed for bankruptcy. For this company, the score is 14.2 and last 3 years the score is more than 5. So it is very good position. And the capex spending compared to sales, it is around 3 to 4% only. So seems it is a capital light business model. And free cash flow compared to sales, it is very low and even negative in few times, so not a cash generating business model. I have taken the forecast details from ICICI Direct May report for this company. Sales are expected to grow at double-digit rate for next 2 years. 11% growth is expected in 2023 and 13% growth is expected in 2024. Net profit growth is not expected to grow double-digit. 3% growth is expected in 2023, but next year 28% growth is forecasted in 2024. The next important section of the analysis, valuation. Here we will calculate the intrinsic value of the business. Since free cash flow trend is not predictable, here earnings is used for valuation instead of free cash flow. We have to make some assumptions for this valuation model. So for this company, here I have taken 3-year average EPS 56.9 rupees as an initial value, and the past growth rate for 1 year is 3%, 3 year is 22% and 5 year 31% and 7 year is 28%. So long term growth is more than 28%, but I don't like to take more than 20% in any scenarios. I consider 12% for the first 5 year and 10% for second 5 years in the conservative approach. For moderate method 15% and 12%. For aggressive method 20% and 15% I have considered. Discount rate is 12%, risk-free rate 8% plus premium 4% I have considered. And terminal value consider the company will be sold at 15 times the earnings at the end of 10th year. That is P ratio is 15. For these assumed values, the intrinsic value of conservative approach is 1407 rupees per share as per the discount cash flow model. For moderate approach 1680 per share, and for aggressive method it is 2235 per share. I prefer to take the conservative only because our assumptions towards future may go wrong. If in case I have missed something, then at least the conservative method will give me reasonable protection. I go with the intrinsic value 1407, and at the time of making this analysis the market value is 2623. It is overvalued by 1.9 times. So market price below 2623 is considered undervalue in my opinion. If you want to buy at the current market price, basically to justify the market value, reverse DCF model to be used to get the growth rate for next 10 years. So the growth rate should be 19.8% for the next 10 years as per the reverse DCF model. Comparing this growth rate with the past growth rate, 19.8% is well under the past growth rate. Even the growth rate seems okay. Earnings multiple ratio seems very high. It is currently around 37 times. So my approach is usually 5 to 10% margin of safety is required from the intrinsic value, or less than 12% growth rate to be required as per the reverse DCF calculation. And at the same time, P ratio should be below 25. So the business is overvalued at the current market price. This is a promoter owned business. So promoter holding is 68%, FIA holds 5.7%, DIA holds 9%, and other investors holds 17.3%. The promoter holding trend shows they are not reducing their holdings. The last 4 quarters of FIAs are reduced from 6.9% to 5.7%, and the DIAs are not reducing in the last 4 quarters. It is flat. But last 3 years they have reduced from 14.3% to 9%. That's all my analysis about Polycab. Our detailed analysis report for this company is available for download. We'll see in another analysis. Until then, thank you. Bye bye.